Hello everyone, I'm Sidhant. Today we are taking the last chapter, the chapter number 18. We already have taken the chapter number 19 of the module C of the BFM. In this chapter we will take the about the derivative products. So in the last chapter as well we have discussed we have taken the example of the derivative products and we have learned what is derivative products. Derivative products are nothing but to protect ourselves for the future risk. We use the derivative products. That's the whole purpose of the derivative products. We have taken an example and I told you to again and again revisit this example so that you could relate this example with the derivative products. For example, you just assume that you are an importer. You imported some goods, so after 3 months you need to make a payment in the dollar form. So what you will do, for example, today the rate of the $1 is equal to 75 rupees, but you are afraid that after 3 months from now the dollar might shift to rupees 80. So what you will do, you will undergo an agreement where you will write everything that after 3 months I will buy the dollar with today's rate, and that agreement is called the forward. Okay, and in this forward agreement the bank or the person who is undergoing this agreement have to pay a premium amount or commission, in simple words. So I hope you have understood what do you mean by that derivative products. So there are lots of derivative products, and for example, one of them is the forward, another one is the future, another one is the swap, another one is the options. So there are lots of things in the derivative products. We will discuss it one by one. And what is the purpose of the derivative products? I already have told you, it is to manage the risk, to cater the corporate customers. How it is catering, derivative products cater the corporate customers. For example, some importers comes to our bank and that importers undergoes an agreement with the bank itself that after 3 months I will buy the dollar at this 80 rupees. So in this contract, one of the party is the importer and another party is the bank. So the forward agreement is done like this. So this bank is nothing but catering this importer, which is our customer. So it is to cater corporate customers. And the third one is to trade. For example, in this agreement can be traded in the stock exchange. Let's say this forward agreement is done by the bank. Now the bank is given sell this agreement into the market. Now someone who needs this agreement can buy this, so it can also be traded in the market. And the basic meaning of the derivative means that the someone which derive its values from the underlying assets. For example, here the agreement is the main paper, but it is deriving its value from the currencies. So it is a derived its values from the underlying assets. Now the derivatives are of two type. First one, over the counter derivatives, and another one is the exchange traded products. You can understand OTC and the exchange traded products with this example. For example, you have gone to the showroom to buy a new car, and when you bought this car after 5 to 6 years you want to sell those car. So buying the car from the shop or the showroom is the over the counter dealing, because you are going to showroom and buying the car and you are doing all the processes, signing and all. But in the exchange traded products, for example, you have after 5 to 6 years you want to sell those car. Now you will go to the OLX. So going to OLX does not have much thing. You just need to press a button. So that is a exchange traded products. So in the real scenario, over the counter products are nothing but the products available by the primary dealers, but in the exchange traded products is traded in the stock exchange. So that's the thing. So what is the main difference OTC and the exchange traded products? The one is that size is standardized in the exchange traded products. It is only be standardized like 100 or 200 or 300. It is not like that 101 and 102. But in the OTC, any amount can be exchanged. Second, the transparent pricing is available in the exchange traded, because in the screen you able to see the daily prices, the mark to market prices, etc. every day. But in the OTC you need to visit that primary dealer's counter, then you can only know that. Third one, the exchange traded products is very easy, because at the home itself you can trade, you can sell, you can buy. But in the over the counter you need to make an auction, you need to put an application. So there is lots of things that you need to do when you are buying a good over the counter. The everything in the exchange traded products is cash settled, means it can be only be sold in the on the basis of cash. But in the OTC it is cash, or in the product itself, or commodities, etc. And the exchange traded products are more liquid, because if you want to sell you can sell easily, but over the counter it is not that liquid. So that's it with the OTC and the exchange traded products. Now we will see that how many kind of derivative products. We already dealt with the forward. What is that forward? It is nothing but an agreement between the two party, that in which it is written that after some time, or let's say we are taking an example time, after 3 months you will buy this good at 100 rupees. Okay, like in the place of goods we are taking N95 mask. So after 3 months you are going to buy N95 mask from A, the B promised to buy from A, and there is an agreement between those. So at rupees 100. So after 3 months the B is bound to buy this 100 rupees and 95 mask. So this is forward contract. But what happens in the forward contract? There is a counterparty risk. For example, what if the B has taken the money but not giving the N95 mask? He ran away. So who will going to adjust the settlement? So there needs a third party, which is nothing in India but a stock exchange. So what after the forward, so this one is forward between the two. So the next, after the improvement, it came the future. In future everything is same as the forward, but only the third party which takes care of the settlements of the amount as well as the product takes care. So this is a future, everything else is same. Now the next is option. Now here we have seen that after 3 months N95 mask at rupees 100, he's bound to buy this. It doesn't matter what is going on, he doesn't have money or not, it doesn't matter. He goes into an agreement, he has to buy it. That is the meaning of that forward of the future. But in option, after 3 months he will have an option to either buy or not buy. So for that he's exercising option, for that he is paying options premium. We will give you an example why he will buy and why he will not buy. For example, there is an option agreement in which it is written that after 3 months N95 mask will be sold at rupees 100. Now after 3 months, for example, the market price of the N95 becomes 150. So what this person will do? Will he going to buy or not? Yes, he will, because he will buy, he will exercise an option, because the market price is 150 but he undergoes an agreement at 100 rupees. So this 50 amount is his profit. So he will exercise the option and he will buy. And what if the market price of the N95 mask is only 95 rupees? So what he will do? He will not exercise the option, he will not buy at all, because he undergoes an agreement that in 100 rupees he will buy the N95 mask. What if he buy the mask at 100 and in the market he goes to sell it at 95? He will be in loss, so he will not exercise the options. So this is the difference between the forward and the options. I hope you understood. Now the next is the swap. We will understand what do you mean by swap. Swap is also a kind of derivative products in which the swaps is done in two of the things. One in the interest rate, another is the currency. So first we will understand how the interest rate swaps happen, which is also known as IRS. Okay, let's say two company A, company B. This company A has AAA rating in the market, so it is a good company, and in the bank, from the bank, he's getting loan at 10% at the rate of fixed, and at the rate of floating, MCLR plus 2%. Let's say MCLR at present is 9%. So this one is 11%. So he will take a loan at fixed percent. Here two things I want to discuss. First, in India, the loan can be given on the basis of rating. If the rating is good, the interest will be less. If the rating is low, the interest will be high. The first thing. Second is, the floating always expressed in terms of any benchmark. Like here it is in MCLR. In somewhere it is in terms of repo or MIBOR or LIBOR, any benchmark rate. So this is the two things I want to discuss. Now this B has double A rating. So this B has lower rating than A. So he can be take loan from the bank at the rate of 12%. And in the floating, MCLR plus 2.5%. So at this present situation, A thinks that I have taken loan fixed at fixed interest 10% and the floating is at 11%. So this A think that at this present of time, in future the MCLR rate will be lower, and this B thinks that MCLR rate in future will go high. So when the MCLR goes lower in future, A thinks that if I would have taken the loan at the floating, it would be very beneficial. I would be have been in profit. And B thinks that if MCLR becomes more and more, and at this present B has taken loan at the MCLR, because here MCLR at 9%, so 11.5 and fixed 12%. So he opted to take loan at the floating. So 11.5% he has taken loan. Now MCLR is increasing. So when MCLR increasing, this floating rate is also increasing. Now B thinks that it would be better if I would have taken at fixed rate. So this is the scenario happens. So in the interest rate swap, these two exchange their interest rate through the third party, which is act as a mediator, which is nothing but a bank or any institutions. So this bank or the institution facilitate to exchange the floating to fixed or fixed to floating as per the needs between the two companies. So this is interest rate swaps. I hope you understood. Now we will see the currency rate swaps as well. So in the currency rate swaps, what happens? For example, two countries. Currency rate swaps happens between the two countries. Say this is let's say Japan. This is India. In India, the Tata company is there, and this Tata company is also operating in Japan. And here in Japan, the Honda company also operating in India. So in India, whatever we are giving loan to Indian companies, we are giving loans to foreign companies at higher interest. For example, if the loan is available to Tata at 12%, Honda will get the loan at 14%. So the same case in Japan, if Honda is getting loan at 6%, the Tata will get a loan at 8%. So what they will undergo an agreement among themselves. So in which they write that the Tata will take a loan on behalf of Honda and take the loan from the Indian bank and pass the whole money to the Honda and pay the 12% interest. So the net 2% gain will be by the Honda, because if Honda would have approached bank, then they will get a loan at 14%. But now due to Tata, it is getting at 12%. So same the case here. It is also here also the 2% gain is getting the Tata company. So this company undergoes an agreement and they do the transaction like this. But it is very difficult to find the mutually two companies agreed on this. So there is a third party, which is a bank, which do all these transactions on behalf of the Tata and the Honda. So this is the currency swaps, and the currency swaps can be of three variants: the principal only, interest only, principal plus interest. So principal plus interest only. And the options premium that we have learned, that in options the in the agreement, whenever someone is get into an option agreement, they need to pay a premium, and that premium is depends upon the volatility of the market, the maturity of the options, and the intrinsic value of the options. So now we will see the questions. So the question 1, if a bank's treasury is buying a stock which is highly sensitive to the market movements, the banks can sell dash as an insurance against fall in the stock prices. So this is talking nothing but a kind of hedging. So what is there in place to hedge the stock options? So this is index futures. The name itself, index, will define the stock. So index future is nothing but an agreement. So this derivative product saves our stock volatility and the sensitivity. I hope you understand. Next question, FIMDA or FIDI that determine the market related code of conduct and other standard practice. On the next question, FIMDA or the FIDI that determined the market related code of conduct and other standard practices fall under the category of, it's a self-regulatory agency. FIDI stands for Foreign Exchange Dealers Association of India. So this body is a self-regulatory agency and it defines the code of conduct and other for the foreign forex market. Next question, SPV that is formed to handle security paper exclusively on behalf of the sponsoring bank is called, it is called a subsidiary company. What is SPV? SPV stands for special purpose vehicles. Whenever there is a need to do a separate project from the main project, they need to form a there is a need to form a SPV. For example, if the government forms any committee to do something, they forms a special purpose vehicles to complete the project. So it's the same thing here also. Whenever the banks need a special to handle security paper exclusively for only that purpose or for only that project, then they form a SPV, and that SPV is a subsidiary company. Next question, capacity of a bank or a business organization to absorb losses on account of market risk is called risk appetite. The capacity of a bank, the capital determines the capacity of the bank. The larger the capacity, the more they are risk appetite. For example, if you take the example of the SBI bought the Jet Airways just because the SBI has a lots of capital with them. So they are risk appetite to take the risk to buy the Jet Airways and to turn that risk into an opportunity to make an Jet Airways profitable. Next question, ratio of interest rate sensitive assets to the rate sensitive liabilities is called, it is called a sensitivity ratio. Just remember this. Banks, next question, banks that intend to trade in the options product should meet with the minimum requirements prescribed for the capital, non-performing assets, etc., and seek permission from, it is RBI. Okay, when the bank, as we have discussed, the banks are not allowed to invest in the option as well as the equities, but there are some conditions. If they follow these conditions or fulfill those conditions, that they can invest, and those conditions are, first one is the minimum requirement of the prescribed capital. They must have prescribed more than the prescribed capitals, plus their non-performing assets is very low. So when they seek an permission on these grounds, the RBI can allow to invest in the option products. Next question, benchmark used for the medium of the long term interest rate swaps are, it is MIFOB, that is Mumbai Interbank Futures Offered Rate. How this MIFOB can be found? This MIFOB can be found through the LIBOR rate plus forward premium. What is LIBOR rate? LIBOR is London Interbank Offered Rate. So this MIFOB can be found with this. And what is this is benchmark. These rates are benchmarks. What are benchmark rates? Benchmark rates are the stable rates, risk-free rates that you can say, and it is determined in the market. For example, repo can be a benchmark rate which determines all of the rate, because repo is more of a risk-free rate. Next question, conventional forward contracts in foreign exchange where the only derivative product available in India markets up to which year? It is 1998. You just need to remember this. Next question, in India rupee market swaps, which of the following is permitted? Only plain vanilla swaps is permitted. Plain vanilla swaps means it is not having any extra facilities or extra things added into the main thing. So it is only the swaps, the simple swaps are allowed. Not much complexity in the swaps is allowed in India. So the plain vanilla is allowed in India. Which of the following is true about floating rate? The floating rate always determines with the benchmark rate. So the option A is always linked with the benchmark rate. Yes, this one is true. Option B, widely accepted by the market players for its objectivity and transparency. Yes, this one is widely accepted because most of the company opts for the floating rate of loan. So this is also true. So the option is here C is the right answer, both A and B. Next question, an option which is exercised any time before the expiry date is called dash. It is called American option, and which can be exercised on the date is called the European option. So in the option we have discussed, there are two kind of the options mainly, the American and the European. In the American, let's say the options maturity date is after 3 months. So before 3 months in any date, the person can exercise the options and can sell or can buy or deny to buy or deny to sell. So in American these things happen, but in European only on the maturity date they can exercise their options. So this is the difference between the American and the European. Next question, dash cannot be sold out but it can be cancelled or rolled over. Dash are tradable, can be sold when not required. It is the option is forward cannot be sold but it can be cancelled or rolled over. Options tradable, can be sold when not required. Next question, the holder of dash contract has to necessarily settle the contract on maturity. It is only forward contract that needs to be settled on maturity. It doesn't matter what, it needs to be settled. Which of the following is feature of the future? Option A is mark to market. Yes, what do you mean by mark to market? Then at the end of the day, what is the price that is decided? In the next day, the same price it will start. Like if you see the example of the stock, at 3 p.m. it is closing time, and at the closing time whatever the rate is there, they will start the same rate in the next day. So that is mark to market. Option B, members are to pay margin equivalent to daily losses. So in this future the margin is paid, as we have discussed in the future that there are third party that is involved. Here we have discussed that in the future there is third party, that is stock exchange involved. So how it maintains that someone should pay it or someone should fulfill the settlement, it takes a minimum amount from both the party, which is called a margin money. And in the margin money, whenever their losses exceeds more the margin money, the stock exchange again demand the margin money, more margin money. So that is the thing. So members are to pay margin equivalent to daily losses. Yes, this one is true. Option C, exchange is counterparty. Yes, in this the exchange acts as a counterparty, but in the forward one of the party can be the counterparty because there is a counterparty risk involved. Here the stock exchange takes care of everything. So exchange is the counterparty. Option D, can be sold through members of exchange. Yes, in the members of exchange means the brokers, in other words you can say. So can be sold through members of exchange. Yes, this one is also true. So the all option is true. Next question, a fixed deposit which can be withdrawn before maturity or a term loan where prepayment is permitted to the customers is a form of embedded option. You need to just know this fact that FD is a kind of embedded option. Stock exchange guarantees all trades routed through its members, and in case of default, insolvency of any member, exchange will meet the payment obligations from its trade protection fund. This is a factual. You need to remember that with the help of the trade protection fund, the stock exchanges guarantees all trades routed through its members, and in case of default and insolvency of any member, exchange will meet the payment obligation. For example, here we have discussed that a stock exchange takes care of all the payment and the settlement. So in this how this stock exchange do this? Through the trade protection fund. Whatever the amount they have in the trade protection fund, they used to do this. So that's it. Thank you. Please like, please subscribe, please share the videos to your friends. Thank you.